worth individuals and family offices. My name is Stuart Kruse. I'm founder of Kruse Asset Management, and I'm a TED speaker, and I have a book coming out called License to Steal: How to Turn Wall Street Greed into Your Gain. I'll be your host today on Money Talk Viewpoint. And for those of you who are not familiar with Kruse Asset Management, we're a boutique asset management firm. We are quantitatively focused, and we run a virtual family office. And for those who know what a family office is, it's when a family has so much money, they hire a team of professionals to manage their assets. Now, most people don't have the $500 million or $1 billion it takes to have a family office. So we have a virtual family office where we work in a team-based approach with your CPAs, your other trusted advisors, to proactively look at some areas of opportunity for your finances. We bring in national experts to help solve and take advantage of these areas for you. And you can do all this without the payroll of having your own family office together. Areas like premium financing, buying and selling your business, captive insurance, reducing your tax, advanced estate planning, and the like. If you want to know how a virtual family office might be leveraged for you, let me know and reach out to me on the information you see below. Okay, so enough about me. We're not here to listen about me. We're going to have a great show for you today. And it's all about a very topical piece of topic, not to be redundant, but we're looking at what are the impacts of sustainable energy? What are the impacts of renewable energy? And our guest today, Brian Jones, who's managing partner of Windmill Capital Management, is focused on creating a positive global impact with clean and renewable energy. Brian is a former tax accountant, investment banker, and CFO of a public company. Brian, welcome to Money Talk Viewpoint.
Thank you, Stuart. I appreciate the time and opportunity to share our views on the marketplace.
Yeah, I'm looking forward to this. I'm excited. I hear from a lot of my clients and people in the industry about this type of investing. And really what we hear about, and I'm curious about your take, is we hear about ESG investing, environment, social governance. We hear that term more in the media. Tell me how it relates to impact investing, or just tell me what impact investing is.
So impact investing often gets associated with and sometimes confused with ESG. ESG really is a measurement tool that's used to evaluate investments in several non-financial aspects, as you mentioned, the environmental, the social, and the governance. And typically, ESG is associated with publicly traded securities, at debt or equity securities. More often, sustainable investing or impact investing is associated with private investments where there are specific outcomes, impact outcomes, typically environmental or social outcomes that are expected from those investments. And it really is a timely topic and an exciting topic. The impact investing market, it really is experiencing a whole confluence of changes that are really exciting for investors and really exciting for us. So it's always interesting to talk to folks about how their own journey toward impact investing and where it fits within their overall family strategy. It's also thought of in terms of value-based investing, where particularly high net worth individuals and family offices can, quote unquote, invest their values. Like I said, there's a lot of changes happening in impact investing, which are very exciting for the space, and I think as a result, we're going to see a lot more interest and capital flowing in towards impact-oriented investments.
Yeah, absolutely. Now, I know from a standpoint of my firm, where we do a lot of work, obviously, with public companies, but you made a big distinction that impact investing tends to be more private equity focused, or maybe it's debt as well. And a lot of our clients that might be portfolios of $2 to $10 million, they don't necessarily have access to some of these opportunities that, let's say, a family office might have access to. So can you tell me a little bit more about like why you think it's growing in such popularity in that space? And maybe it's growing, in the high net worth space too, but talk a little bit more about, that focal point.
Well, I think overall there's greater awareness. As you said, ESG has become a huge vehicle around which capital has been raised. ESG has its own sort of issues, lack of definitions, lack of measurement, and things like that. But I think the trend overall is towards greater awareness of the types of investments that we're making beyond the financial outcomes. And so that, for the average investor, the Main Street investor, if you will, there's still plenty of opportunities to invest in impact. There's impact comes in a whole bunch of different forms. There's microfinance, there's investments around education, there's investments around workforce housing, those types of things that are all accessible to most investors through their financial advisors. But again, they tend to be more private structures that they have. Our own focus within impact is renewable energy, and our fund is oriented towards higher net worth individuals, family offices, foundations, endowments, et cetera. But there are more and more opportunities for investors of all types and capacities to invest in impact. And I think that one of the best things that we're seeing out of impact investing is managers have better ability to measure and report on that impact. And I think that that's an important aspect that the adage is, that nothing's important unless you measure it. The measuring what that impact is, and being able to report to investors exactly, whether that's in terms of greenhouse gases eliminated, carbon dioxide emissions reduced, jobs created, education, educational outcomes, low-income community outcomes, all of those different things can be more accurately measured, meaningfully measured, and reported to investors. And I think that in addition to greater awareness is, are two of the leading factors in why this is becoming more commonplace, more popular.
Yeah, it seems to me like there's a big shift in the investment language, if you will. Like when I was growing up in this industry, before I had all the gray hairs that I have now, it used to just be all about shareholder maximization. Like that was what it was coined. And if you kind of study this, and I wish I really studied this a little bit more intensely, but at one point somebody said that was the goal of any company, was to maximize its own shareholder value, and then everybody else would take care of itself. But now it seems like there's a shift, at least in some circles, where it's not just shareholder maximization. You need to maximize the stakeholder value. So even if the person doesn't own share in the company or in that investment, but they are affected by the investment or the company itself, they are stakeholders in that company. Like maybe they're downstream from a water source, or they're around the air, or what have you. So I think there's been a palpable shift away from just that myopic shareholder value investing and optimization, right? Have you seen?
Yeah, I think that's absolutely right. We're definitely seeing more of that, and a lot of it is because it's in the past it wasn't effectively priced into a company's operations, and increasingly, and climate change is a great example of that. Companies committing to zero carbon or carbon neutrality, those costs those indirect costs are being priced into companies' business models, and that's in part what's what's driving, again, that awareness and the measurement and that broader stakeholder outlook, as opposed to just who are the owners of the company.
Right. So you touched on this a little bit. You hinted at this, being able to measure specific criteria that are not normally on the balance sheet of a company, right? But I looked at Windmill Capital's website, and I see it says they're addressing 16 of the 17 United Nations Sustainable Development Goals. So can you give me some examples of, like, very specific examples of what impact investing strategies you've been using, or some of the companies you've been working on investing in, and some of your brightest spots?
So we are an investor in commercial scale on-site renewable energy assets, which means that we help companies typically finance on-site energy production, which is cleaner, cheaper, and more reliable than utility provided energy, and to benefit from that on-site energy production, essentially on a pay over time type of model, where they're paying for the energy, whether it's electricity or thermal energy, and they're paying for that over time. And so we're enabling the growth of renewable energy by providing that financing, through our ownership and then sale of the energy, and the benefits. The United Nations Sustainable Development Goals cover a whole host of things, from water conservation, which we see particularly in people are unaware generally of how much, particularly in building heating and cooling, how much water is utilized, because you're typically using evaporation chillers in traditional heating and cooling, and alternative energy, including geothermal, can eliminate virtually all of that water evaporation. So it's preserving accessible water for human consumption and agricultural uses. Another of the SDGs relates to of course the environment itself and climate change, and we all know the benefits of renewable energy towards climate change. The SDGs relate to education, and again, we work with renewable energy developers that are focused, in some cases exclusively, but at least partially, in providing renewable energy for schools and colleges. And I was unaware of this fact until recently, but our public school system represents, I think, the third largest investment in city, state, municipal owned facilities in the country. And so our ability to provide cleaner, cheaper, more reliable power, heat for those facilities means that there's more resources available to actually educate kids, instead of operating those facilities. So things like that to me are super exciting. I look at my own kids' education experience, and there's a constant struggle over funding for education. It doesn't matter where you live. It doesn't matter the community, the state, the level of education. There's never enough money for it, and we feel like we can make a big difference by making a little difference a bunch of times, right? So one school doesn't mean a whole lot. 2 schools may not mean much more, but a dozen schools, 100 schools, 500 schools, 1,000 schools, we really start to move the needle. And that is, that's that collective, working collectively to make to create a substantial impact. And that's, it's things like that to me are really, really exciting, and it's gratifying to work with folks that are, that have dedicated their careers, 30, 40 years to, these types of things that are now just now getting more attention. in the marketplace, more recognition for what they are. And overall, it's just important to remember that climate change affects lower income households, communities, and countries more than it does wealthier communities. So, virtually everything we do on impact has a beneficial, a beneficial effect for even if it's indirect, for low income communities.
Yeah, so that's great. I have 4 kids in public school right now, so that's great to hear about the public schools, and obviously an altruistic endeavor that will lift up society. What about something that's a little bit, I'm going to go with the word dirtier, that has been getting a lot of bad press? I have enough knowledge in this area to be dangerous, but let's say crypto mining. So it just struck me, you said I'm using on-site energy, renewable energy. We were talking about potentially launching a crypto mining fund, and I know the 3 characteristics of whether this is going to be successful is hash rate, which you don't have that much control over, but energy costs and the price of crypto. So those who can get access to lower cost energy tend to win. And
Right.
if you make it on site and or figure out a way to do it from a renewable standpoint, that's where crypto mining really gets its bad blemishes, is the fact that it's just hurting the environment. So have you guys gotten involved with that aspect of the crypto space?
So we're not yet involved with crypto in that way. We've studied the space quite a bit, and you're absolutely right. A few years ago, it was more a capital cost around the hardware and the software programming and to maximize hash rate. And now that those costs have come down, really the critical factor in profitability, relative profitability among crypto miners, is going to be the cost of energy. At the same time, they've gotten a lot of pushback because they consume a lot of energy, and there are questions about the social benefit of using all of that energy, and staying out of that debate. The energy issue has been central to a lot of the success in crypto, because there have been utilities that have curtailed energy to crypto mining when they've got other needs within the system. So we've talked to a number of folks who are utilizing or have plans to utilize some sort of waste energy or waste fuel to power crypto. There's a lot of examples of that out there. We're actively looking at those. It's a little bit different from what we typically do, because our focus really is on technologies, renewable energy technologies that are proven, well established, so that we know what the output is going to be. We can reliably measure that output, and we can also reliably measure the costs associated with operating and maintaining those assets. And then from the revenue side, we typically look for longer term agreements, so that the revenue has greater level of predictability, which typically you don't get in that crypto type of offtake, because the profitability is going to depend on what the value of the whatever tokens it is that they are mining. Having said that, there are a lot of opportunities. There's a lot of creative folks, and there's a lot of money to be made in that type of business, and so we're going to see more and more of those types of opportunities, coming out where they're using some alternative energy source, either completely renewable or partially renewable, to reduce their operating costs and increase profitability.
Yeah, I've seen on the crypto side, as you mentioned, I've seen people like use off-grid energy where instead of just flaring the natural gas that's coming out of oil wells, they were trying to tap into that and use that energy, reduce the cost considerably, as opposed to just wasting and flaring the gas. But that kind of brings me up to a question. So how do you decide where you guys are gonna go? Does Windmill Capital have a mandate on particular companies that you want to invest in, or what's your criteria on where you're going with your next dollar and your next kind of project to make a big impact on the globe?
So we look for a few things, like any hard asset owner. We're looking at particular markets and geographies. We have a global mandate, but typically our investments focus in North America, the Caribbean, the UK, the EU, and certain other markets. But that's generally where we get the most stability. And again, we're investing around that stability. We're not an opportunity fund. We're not a venture fund. It's a hard asset, real asset fund, hard asset fund. So that's sort of the first point. The second point is something that we know is going to be sustainable. The assets that we're buying are 20, 30, 40, and in some case 50-year assets. So something that we know is going to perform reliably over that holding period, or over that life cycle, is sort of the next criteria. The next is the management team. I mean, we're working with developers. And typically those developers are, we contract to operate the assets once we own them. Some renewable energy technologies don't require a whole lot of operating expertise. Things like solar, where the O&M is relatively straightforward, is sort of one end of the scale. The other end of the scale would be some sort of a waste to fuel or waste to energy, where you actually have employees full-time on site. So the ability of that management team, the proven experience of that management team to knowledgeably develop and operate the assets is sort of the next. And then I would say the last and perhaps most important is scale. The one-off investments in renewable energy could have value, but we find real value creation in scale. So the ability to, as I mentioned, schools, owning on-site energy production in schools has some value, with a handful of assets, but there's real value in ownership of 100 assets or 200 assets. And so the ability of our operating partners to scale, to manage their growth, is an very important consideration for us. We think that there's not only is the scale drive impact, which is important, but we think that there's also opportunity for step change in value from aggregating portfolios of assets at scale.
Yeah, you would have to have scale to have an impact, right? I mean, it's kind of
there's no question. There's no question. And we around that, we also say that when we look at the landscape of renewable energy technologies, that innovation is nothing without scale, right? If you can't deploy your innovation at scale, the value of that innovation is far less. So we have to be able to deploy at scale. And by the way, I mean, we're not making this up, right? A lot of the things that I'm saying are the same things that we're hearing out of the Department of Energy and other folks in this space, right? I mean, we just happen to agree that that's the right way to operate.
Sure. So you mentioned something to me that didn't really click with me before. You said you're a hard asset fund. So then immediately in my head, as an asset allocator, started spinning in risk management. right now we're in an inflationary environment. I think it's going to be relatively persistent, but let's just say Powell gets his handle on it and we do bring inflation down to some extent. Or the opposite could be true. We could return back to the 70s and 80s. We've seen a lot of global stimulus and it may be more persistent than we think. When I think of hard asset funds, that I think of something that has a inflation hedge, if you will. Can you talk to me about the correlation between like where your fund would be, the profitability of your strategies versus an inflationary environment?
Yeah, so typically our even though we have the assets that we own have long-term agreements for the sale of power, there is some sort of growth in that contract. Either part of the contract resets to market levels or for prices of electricity, or there are fixed annual steps in the price. So we see we typically look for growing income streams, growing revenue streams, so that we can, to the extent that we have increases in our operating costs, we're able to offset that in order to continue to provide a high level of distributable cash flow. But I agree that the hard assets certainly have that inflation protection embedded in their value. The assets become more expensive to build, more expensive to replace, which means that the existing inventory of assets should also appreciate in value in a like kind. So we do think that there is an inflation protection that's built in, again, both on the asset side, capital side, and on the income side, cash flow side.
So thank you for that. In looking at your website, something struck me, and I always get the question about ESG investing, and I know you said they're not the same, but from a public standpoint, that's what we're looking at. You said this was much more private. You had a phrase in there that was beyond profits, and we touched on this a little bit, but can you tell me a little bit more about your investment thesis for renewable energy and the profitability within that space? Because at the end of the day, when people are putting money at something, ultimately they want to see the return. So they want there to be some sort of viable, not just an altruistic donation to, make you get so much resistance. Public schools are helpful, but every time there's a vote to raise the taxes, they vote it down, right? So it's got to be a profitable venture for people. So tell me a little bit more about how that works for you guys.
Yeah, you make a great point. It's important to distinguish, impact investing from donations, right? This is not philanthropy. There at the end there has to be a viable and reliable economic benefit to the investments. And I think one of the things that's made impact investing more popular, in addition to the social elements, are that there are fewer and fewer trade-offs between the social impact, the impact benefit, and the economic return. It used to be that you would expect from an impact investment there to be a lower economic return in exchange for the impact that's being delivered, and that is increasingly not the case, that you have to make these trade-offs, and particularly in renewable energy, the trade-offs, I don't think there's a trade-off at all. I think that we are able to generate market level risk-adjusted returns from our investments while delivering substantial environmental and social impact. And the things that are driving that, I mean, it happens to be the end of February, and we've had a significant weather system move through really the entire state of California. I'm in Northern California. The power at my home has been out for the last 48 hours, and which would not be that great of an inconvenience, but the kids are also out of school this week for President's Week. So, it's sort of it's a little bit of a double whammy. I'm lucky that my office, which is not far away, we have power here, but we've been without power because of a down power line at my home for
I was going to ask you if you're on a renewable energy bicycle that was powered.
So yeah,
my camera and your computer.
My 15-year-old son has volunteered to pedal the generator so that he can play video games. The economics of on-site energy production, as I said, it's cleaner, it's cheaper, and it's more reliable. And I think that from a pure economic standpoint, cheaper power, is always going to be favored over more expensive power, and for whether it's hotels or apartments or business, real estate owners, municipalities, the opportunity to pay less for your power. There's a clear economic benefit, right? It's making your business more sustainable. It's making your real estate asset more valuable, or at least more competitive, if not more valuable. So the ability to deliver power at a lower cost is important, and we're able to do that, through renewables and for a number of different reasons. Obviously, in the last 10 years, the cost of renewable energy technology has come way down as a result of production having gone up. But we also, in the U.S. at least, have huge government incentives, tax credits, and other incentives that subsidize the cost of that energy. So, virtually everything that we do in the U.S. is benefits from a 30% investment tax credit. That's like 30% free equity for these projects. So, from an investor standpoint, that's a nice benefit, but it also means that power can be offered under a long-term contract more cheaply. Reliability, like I said, I'm experiencing the whole reliability thing right now, and between increasing severity of weather events, the problems with the grid and transmission. There's a whole host of reasons why power reliability is going down when we look at grid provided power, and at the same time, the costs of that power being out are higher and higher. You can think of, some extreme examples. If you're an owner of a data center or an owner of a crypto miner, without that energy, you're out of business. There is no business to be had without that power. The same could be said for apartments and hotels and senior housing, and for a whole bunch of other different businesses. So that reliability is increasingly important, and the lack of reliability becomes increasingly expensive. And so when you add those two together, the thesis around why people want to utilize on-site energy is clear, but then you also add in the fact that it's cleaner. Depending on the type of technology we're using, it could be up to 80% cleaner than utility provided power, and that is, that's an important impact element. I personally believe that climate change is the greatest risk that we face today. And that it's something that needs to be addressed. we have, but importantly, we have solutions. We have solutions today that, you know, if they're deployed in scale, we can address, you know, the 2 degrees of global warming and carbon dioxide and other emissions. You mentioned flare gas, and, you know, methane is a terrible greenhouse gas, one of the worst greenhouse gases, and so we prioritize the impact that from our investments, but the economics really come first. I mean, you know, in all transparency, when I first started looking at this segment, it was driven by the economics. It was an economically driven analysis that we performed, and the impact was secondary. But we make the impact, you know, as far as measurement and reporting and everything, you know, on equal footing with the economics, just to you know, as a rudder, as a keel for the you know, for our business, to make sure that we remain focused on you know, examining opportunities to provide that impact.
Yeah, it's so interesting. I think when I grew up in this space, so my undergrad degree is in chemical engineering, and I used to work at Goodyear. And so this is back in the late 80s, early 90s. And I actually at one point put on a suit coat made out of those 2-liter Coke bottles, polyethylene terephthalate, or PET is what it was. And the dream was to be able to recycle this PET because it was the #1 most recyclable plastic there was on the planet. But it was far cheaper to make it from virgin materials than it was to actually gather the bottles and recycle it and purify all this stuff. So there's been a discussion. I was actually this weekend over with a discussion with a bunch of, I consider to be very intelligent people that were trying to plan, you know, or trying to hypothesize of where they thought the world was going to be. And one of the viewpoints was that it's going to be a better place because whenever we get to a certain problem threshold, like when we saw oil was at what, 160 a barrel, that so much capital flowed into that industry, it helped spur more economic development and helped spur other avenues for energy creation. And so what's, I guess, swirling in my head is your 30%, I guess, head start, if you will, from the government and this economic disparity. Where is the break-even point, do you think? So that's one question. And the second question is how it used to just, as you said, just be about the economics. Like at some point it was like, once we get to a higher economic trade-off, the investments will flow. You just won't be able to help it. It will happen. But there's been much more of a desire for the other side. And if you're leading, or at least putting up, you know, all of the impact statistics as well, how much has that really affected the money flow? Like, is it like, what percentage? Would you give me a guess of like percentage of decisions that people make on the impact metrics versus the actual just solely economic metrics? It used to be 99-1. Like, what do you think it is now?
Right. So, so on the second question, you know, as you said, you know, 99-1 might have been a generous estimate, you know, because people, what in the past people just made a distinction between what their investments were and what their philanthropic activities were, right? There wasn't a lot of opportunity to blend the two. Now you have an opportunity to, and you know, I particularly, you know, talking to foundations and endowments here, right? I mean, if you have a mission to provide some social good, why not have the preponderance or all of your investment portfolio likewise targeted toward that positive social outcome or other positive social results, environmental results, et cetera. And so we're seeing more and more of that come into the calculus, but it really is on a case by case basis, right? We're talking broadly, it's increasing. But I think on a discussion by discussion basis, there are some investors that are still that are interested in what we're doing purely because of the economics, because they have an interest in energy more broadly, because they have an interest in real estate, and investment areas, commercial areas that are sort of adjacent to renewable energy. There's sort of a natural affection for or an interest in what we're doing, and so you have that. And then there's other folks that find us or find us interesting because of the impact side, because they've gone through the process of doing a values assessment, and particularly as they've been talking for years about the great wealth transfer from the boomers to the next generation, and as that upcoming generation gets more involved with investment decisions, that as a generational matter, that younger cohort is more interested in the impact, both negative and positive, avoiding negative impacts and creating positive impacts of how they invest their money. So there, it's always evolving. It's different for every discussion, but as a general rule, it's definitely increasing in how investors look at what we do. From the first question, it's each of these markets are super interesting. I think we've looked at plastic recycling, and you mentioned working for Goodyear, the recycling of tires, and I can remember as a kid, tire fires that took years and years to go out, and how the government addressed that, and there have been little publicized programs or long forgotten programs perhaps that have incentivized greater recycling of certain materials, tires, right? The core charges and things like that, and they've done the same thing with computers, right? Where they're charging a recycling fee, they're building that into the price. Plastics are likely going to see some other mechanism where there's actually an economic cost that's tied to plastic pollution or plastic waste that's gonna prompt greater recycling of those materials, and perhaps put recycling economically on the same footing as virgin materials. We're going to see the same thing, I believe, in water, where water is going to be increasingly scarce, and there's going to be a way to trade water conservation the same way we can trade carbon credits today, either voluntary or involuntary. And then, of course, in the renewable energy markets, it's interesting. The 30% has been in play for solar and wind power for quite some time. Certain other technologies as well benefited, perhaps to a lesser extent. But what the Inflation Reduction Act did was that it allowed virtually all renewable energy technologies to take advantage of that 30%. So it broadened the usage of the credit, and at the same time it extended the credit for a longer period. So it increased the access to the credit, and then it gave greater visibility around the credit, because typically these credits aren't used by the people who have who've developed the project or own the project in the long term. They're securitized and sold, or they're monetized in some other way, so that they can be utilized by folks who have tax liability. So there's so that's an important element to that market, creating more efficiency and clarity in that credit market. But we've been working on this fund for nearly a year. And so we started it well before and formulated our investment theses well before the that credit was available for the types of projects that most of the types of projects that we work on. And those projects were able to stand on their own economically before the 30%. The 30% just makes it a lot easier to reach economic hurdles and reduces, it de-risks really, because you're reducing the equity investment that you're making, and so that equity investment can withstand greater fluctuations in cash flows to meet the targeted return. So that's how I look at it. It substantially de-risks the investments, and it does so for an extended foreseeable period of time, and so that's there is certainly an economic benefit, but that risk reduction really is, I think, what is most important for most investors as they consider renewable energy, a segment that they might not otherwise have been have much experience with or be thinking about. There's definitely a reason to outside of the environmental considerations, there's a good reason to consider the segment and to learn about it, and so that's a lot of what we do, is just educating folks on what are these technologies, how do they work, what are the economics around them, those types of things, because it's a familiar space, but it's not a space that people have deep experience in necessarily.
Yeah. So if a family office wanted to pursue an impact investing strategy with renewable energy, how would they go about doing something like that?
So, for us, like I said, I think it is difficult to pursue an impact strategy around renewables in a public format. There's certainly publicly traded companies that have direct, whether they're manufacturers or owners of those types of assets, manufacturers of different various components, et cetera. That's one way to invest in the segment through public investing. I think the best way to invest in the actual ownership of projects is through a private investing, and that at least is true for now. And that's partially because there's not a tax efficient way to own these projects in a public format. Our fund is a limited partnership. We pass through the income without a corporate level of tax. If we tried to do the same thing in a public structure, we'd incur a corporate level of tax, and so it would reduce the return. So there's no renewable energy REIT that you can own today, right? Where there's a tax-free pass through. The energy equivalent would be the oil and gas master limited partnerships, or MLPs. That's not available today. So again, I think the most efficient way to invest these projects is through direct investment or through private investment, a fund, and because scale is so important. I'm self-interested here because we run a fund, but I think that because scale is so important, and it continues, particularly the commercial segment in renewable energy is so fragmented, that it's important to have somebody who's in the market like Windmill full-time, talking to developers, working with them, understanding the landscape, understanding the development issues and supply chain issues, and seeing a greater flow of opportunity, and then also being able to aggregate capital from different investors in order to create that scale. And again, I think that there's tremendous impact as well as economic value in creating that scale. And so pooling capital with with other families, high net worth investors, et cetera, is that, creates that opportunity. So there's a few of us out there that are in this space, and so it's, locate guys like us that and find one, and then from there it's your typical sort of manager diligence. I mean, beyond that, it's even though there's an impact element, and we write about this quite a bit. We've talked to a lot of family offices and stuff, and there's from a diligence standpoint, it's the same type of process, and it's just as important running diligence for a private renewable energy manager as it is to run it for any other hedge fund or other private manager that you're going to be working with, and perhaps even more important, really, than because you want that manager's values to align with the values that that's, if it's an impact oriented investment, you want those values to align, as well as the business acumen and experience and those sorts of things. So diligence, like I said, maybe even more important for in the impact space.
You did leave off of one benefit that's glaring for me as an asset allocator. You mentioned REITs. I had started a REIT of golf courses once in the late 90s and imploded upon itself. But if you look at the history of REITs, the whole point was underlying real estate tends to not move in conjunction or lockstep with the stock market or with the bond market. But so the correlations for real estate, 20, 30%, but now publicly traded REITs will often trade in the 80 to 90% with the public markets, even though the underlying real estate's not correlated at all. Right. So I imagine it would be a very similar situation as a private investment, that especially a longer term private investment that are marked to market, over longer periods of time. You have much less volatility, much less fluctuation, that much greater diversification benefits than you would if you were investing in a privately driven or a publicly driven company.
Yes, no, and I think that's particularly timely comment given what you mentioned before. We don't really know what's going to be happening with rates. The inflation picture is murky. Global geopolitical environment is complicated. All of which is headwinds for the public markets, and whereas in the private markets we're the circumstances on the ground are quite different.
Yeah, exactly right. Can you tell me a little bit about your before we wrap up, about how somebody would invest in your fund? You have tell me, is it one fund? Do you have multiple funds? What are the minimums? What are the lockup periods? Those kind of things.
We have we have one fund that we're managing now. It's our first fund, so we're very excited. It gets 100% of our attention, 110% maybe. Yeah. It is targeted towards family offices, foundations, and endowments. There's a $1 million investment minimum that can be waived by us as the manager. It's a 5-year fund with 2 1-year extensions. So the notion is, as I said, to aggregate assets and then capitalize on the portfolio premium as I see it, and I think that there's a lot of evolution that's happening in the energy markets more broadly. These independent power producers are going to be a completely new sector, and so I think that we've got multiple exit opportunities, but it's it's all locked up. There's no redemption period, but like I said, it's a relatively short term fund for a much longer term investment, and our focus in that fund is the ownership of operating assets. We intend to buy assets upon completion where we are putting our capital in concurrent with the commencement of operation of that asset and the cash flow from those operations.
Well, that's fantastic. Brian, it's been great having you on the show and learning about the evolution of impact investing and how renewable energy could fit into your investment portfolio. I hope the audience learned a lot. I know I did. It was fantastic. How can people get a hold of you?
We are on the web, as you said, windmillcapitalmanagement.com. A little bit of a mouthful, but once you type it the first time, then you don't have to type it anymore. Windmillcapitalmanagement.com. You can connect with us there. And then, of course, LinkedIn. I think the company and my personal LinkedIn information will be included below.
Yep. I am sure we'll put the links down below in this recording. And if you think you'd make a good guest on Money Talk Viewpoint, please reach out to Chantel Leeson. The information there will be below. Learn more how you can get involved with getting your ideas out to financial professionals, advisors, other centers of influence, so that we can all become better informed and make the world a better place for generations to come. My name is Stuart Kruse, and it's been a pleasure to be your host on this show. Thanks for watching, and let's always work to be a little bit better every day.